Before we can get started. I've noticed that when the YouTube stream starts, when I hit the button, it takes a few seconds. I think we're there now. Hey there, folks. How? Hey there, folks. How are you doing? My name is Peter Hartman. I'm here with Tom Hartman, web programmer and marketer. We're going to be talking about crash proof, how to profit from the upcoming crypto collapse. I hate spoiler alert. There's going to be a crypto collapse, at least as per Tom. Tom, why'd you choose this as a title, and what are we about to about here today?
The title came to me in a dream. It's very original, and I thought I had to jump on it right away. I don't even think it's trademark. I didn't even have to check. Honestly, I think no one else in this space is saying anything about it.
Well, look, we're not burying the lead here when we're saying that this whole thing we're doing here is because you believe a collapse is coming. You want to give us a sense of why you think that? And actually, before I ask you that question, what are we doing here today? We're doing a rundown of the upcoming collapse. We're talking about market indicators. So if you love your charts out there, you're going to be learning a little bit about charts, the predictive nature of charts, and how you can use that to your advantage. And what else? What else are we talking about here?
Well, just to contextualize it, in the videos we've been doing over the last a year or so, we've really been talking about the importance of becoming financially literate. Right? When you have being financially literate is the same thing as being aware of the weather if you're a farmer. It allows you to plan better for the future. And so we've talked about different charts and we've talked about different resources like realvision.com. That Netflix for financial information that's trying to democratize financial education for the masses, and we've talked about it a lot, and we've pointed to other people's videos and other people's research and stuff like that. But I sort of want to dive into the idea of using these charts, using these signals for yourself, like really paying attention. I think it's important that over the course of the next few videos that we really start showing this is how you read a chart. This is how you use this information in order to make your decisions. And so the crypto space is very interesting for this because the crypto space is very sensitive. It's a new medium. It's not as much money in there as there is in the stock market or the bond market, and so it moves a lot. It's very volatile. It's very new, and it responds pretty significantly to the conditions, the financial conditions that exist broadly in any given country and in the world in general. So I sort of want to uh, have a little bit egg on my face, right, Peter, about predicting or talking about Bitcoin reaching $100,000 dollars per Bitcoin or $300,000 per Bitcoin at the end of last year. It was November and Bitcoin had peaked out, and I was like, "Oh my God, buy some Bitcoin! It can go through the roof."
You're not the
And
only one who was saying that. A lot of people had egg
exactly.
on their face.
And so and you at that time had actually told me, "Hey Tom, there's some chatter here. There's some people talking about the idea that maybe Bitcoin has peaked out here, like when it got to its all-time high of 69,000, and that it would fall pretty precipitously to you were saying 10,000 at the time." And I'll be honest, I didn't want to hear it. All right, I was not in the mood to hear it. Bitcoin is making all-time highs all the time. I was even considering putting laser eyes on my avatar pictures on Twitter. Not really, not really. Can't stand people who do that. But I did want to pay attention, and I didn't follow the advice that I've been giving other people, which is uh, to be aware, to manage your positions, to really use economic data in order to inform your decision. Really, like the zeitgeist at the moment caught up to me, and so when Bitcoin fell from 69,000 to whatever 30,000, I was sort of like, oh my god, like what happened here? And it behooved me to go back and check. Okay, what were the false assumptions that I had? Why did I say it this way? And what were the signals I could have looked at in order to let me know that Bitcoin would fall pretty dramatically? And when I did that exercise, I noticed that those same signals were saying that not only did it point out that yeah, the top in Bitcoin was in at 69,000 in I believe November of 2021, but that we're not done yet. We're not necessarily done yet with a drawdown with the amount of downside risk that there is to Bitcoin. Not saying for sure it'll fall. I'm no longer saying for sure it's going to fall, for sure it's going to go up.
Guaranteed
Um,
collapse. Crypto
but
winter.
exactly. But I just want to point out these things to people so that I hope you feel compelled to go and look at it yourself and look at these charts yourselves and keep an eye on it. Maybe you're not trading crypto day by day, right? But it's just super useful to be able to look at a chart, come up with your own opinion as to what might happen, and then see if that thing actually happens or not. It's very satisfying and useful for your daily life.
So it sounds like you're going to bore me with charts here today, Tom. If I got crypto, I got
I'm
Bitcoin,
going
I
to
got
dazzle
Cardano.
you with charts.
But so I'm sitting there with my bag of crypto. I got my Ethereum, I got my Cardano, I got my Bitcoin, I got my XRP, I got my Polkadot, I got my Doggy Coin. If I'm not really that interested in charts, okay, am I going to get anything out of this stream here today? Am I getting anything out of this education you're about to give us? Or do I have to, fall in love with charts? Not that charts aren't wonderful.
So you don't have to fall in love with the charts. The charts is what I find particularly useful. But what is interesting is that the terms that we're going to be using are the same terms that you hear when you're listening to financial information, or even as people speak casually. And it's nice to know. To be able to have a grasp of, so what is it that they're talking about, and they be able to point out the BS from the non BS. When someone is making a claim and they lay out their assumptions, it's nice to be able to go and check those assumptions. So sort of consider this like, I'll spend some time, or Peter, you and I, we spent years watching a film riot, right? Watching these people that show the technical nature of behind filming and shooting movies or short skits. And we we never even had a camera. Like, we just wanted to know. It was interesting watching people who were discussing these technical things, and it was useful for me later on when I was doing web design, right? How to think of color, how to think of motion and compositions. You understood that a little bit more when you decided to do video editing, right? A few years after that, you were like, okay, this is useful information. And so being exposed to it is something that I think is super 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 useful.
I'll tell you the predictive nature of the markets. It's really interesting to look at. I look at a chart. I understand what 5% of what I'm seeing on the chart, but that 5% what I'm seeing is so exciting. Is so interesting. The waves on the chart, the way it moves has a predictive element to it where you can kind of foresee what's coming. And uh, look, when I grew up in church, just like you, Tom, and my favorite book in the Bible was Revelation. Why? The last book of the Bible. Why? Because it talked about the future. Everybody's like talking about Genesis and talking about Isaiah. I want to know about Revelation. Tell me about your predictions of the future. Well, the greatest predictive tool that I've seen for the future right now so far are the predictive markets. That and following whatever Elon Musk decides to do. It is absolutely fantastic. So if you don't have to understand everything about these charts, but just get a sense of what the charts are telling you, and you'll be able to predict the future. Why do financial markets predict the future so clearly?
Well, it's not predicting the future, right? What happens is that it just seems that way because of how useful the information is, and so it's about probabilities. What could happen and what's likely to happen, and
Mhm.
so as you see that probabilities of things get narrower and narrower and narrower and narrower, that's where the predictive nature comes into play. You go, well, I mean, now it's far more likely for this thing to happen. I see it like in Plinko. Remember Plinko in Price is Right, and the someone drops a disc through this grid, and the Plinko is bouncing back and forth, back and forth, back and forth. And at the beginning, before the person lets go of the disc, it can go into one of 10 numbers. But as it gets lower and lower and lower, the numbers on the outskirts become less and less and less probable until you get to the one where it lands in. And so, in marketing, we know this, like in different fields, but that's what I work in marketing. You can't necessarily predict what one person will do, but you can almost definitely predict what a million people will do if faced with the same decision. You have this sort of probability spread, and so it's understanding. I just find it so unbelievable that a lot of people will make decisions about the future based on either outdated information or things they heard on the news, right? Which is people's opinions and what they think and their biases. Well, the markets don't really have any of that bias, right? When you're dealing with people who are investing billions to trillions of dollars, these people aren't just like flipping a coin and go, well, I hope the trade goes well. I hope Netflix goes up next year. They're doing massive amount of researchers, people whose job it is just to try to figure out what's going to happen in the next moment. And the financial markets is an aggregate of all that information. So it helps you a lot in order to decide what you should do in your job, in your life, how you should invest, how you might be able to um, use that information to make money in the future.
Look, these people who are spending hundreds of millions, billions, even trillions of dollars investing that, these guys are analyzing every detail of everything, right? They've got boots on the ground. They're talking to the secretary in the office. They're down to the factory floors and all the details that are there. They have a history of data to be able to analyze what's going on right now. And my favorite thing that you show us with these markets is what happens just before an event, right? What does the chart look like just before something happens, a crash happens, a boom happens, or whatever? And there are people out there who know these things, and Tom is one of these people, and you're going to be able to give us a little insight into that here today. Very exciting.
That's right. So I'll just preface it by saying that I'm not a financial expert. I'm not giving you financial advice. You do your own research. What I'm trying to point out here is things that I find useful, ways that I find it's useful to look at the markets. And if you find it useful for you, great. So what we're going to be focused on today is the idea of money flows, that the how much money is flowing around in an economy, which is something that directly affects every single person in their day-to-day life. It affects uh, teenagers who have to decide what they want to major in the future, or what technical expertise they want to have, because they have to figure out, will that job exist when I'm there, what salary might I be able to make, and so on. You might decide it if you're an employee. The amount of money sloshed around in the system tells you, gives you information as to whether now's a good time to go out and get a new job, or try to get a new job, or not. If you're an employer, it allows you to know, should you build up inventory supplies now so that you can sell later on, or maybe you should be downsizing your staff. There's all kinds of different components in our economy that is dependent on the amount of money flowing around the system. Think of it really like the weather, right? As things get colder, your options change, and then as things get warmer, your options change again. And it'd be silly to plan a trip to a warm and sunny place when it's not going to be warm and sunny, right? Peter, you would say that's ridiculous.
Yeah, people like come to vacation in Canada, and they come in February, and they're like, "Oh, I came to see the nice environments." It's like,
Yeah,
well, you
the
picked.
prices were cheaper, and they're like, "Oh, that was a good thing to do," but they didn't realize that the cheaper price was the signal, was a financial signal that that's not a good time to not a good time to go.
One of
And
the
so
signals is all the Canadians leaving Canada for the winter and going somewhere else.
exactly, exactly. And so we're going to be everything we're going to be seeing today is about the flow of money throughout the system, mostly focused on the United States, but it has global impacts. And so I think we should just jump right into the charts right now, as I give you sort of a little primer on money flows before we get to Bitcoin. Sounds good?
Well, actually, before we do that, before we dive into these charts, I want to just start at crash proof. Okay, I'm going to start with the conclusion first. Do you believe there's a crypto crash coming or a stock market crash coming?
Yes, I think we're in it already. I think we're in that crash. If you've anyone who pays attention to the stock market or crypto market, the Nasdaq, the tech stocks are down. The index is down like something like 20% for the year. 20% down on the year is pretty significant for the stock market. If you're up 15-20% at the end of the year, you consider that to be a pretty good year. So to already be in March and down 20%, that's pretty significant. I mean, you have to be up more than that in order to get back to just break even. Also, the crypto, we've seen Bitcoin hit 69,000 in November 2021, and now it's floating somewhere around what is it, 39,000.
39.
And so there's the question is, if this is the bottom, then this is a good time to buy, right? That's the question I was asking myself. Is this a good time to suggest to people to buy some Bitcoin? And when I did the research, I go, no. And it turns out that the crash that we're in, there are certain signals that we're going to be looking for that indicate when the crash is over and when it's safe to get in. So it's sort of like in the dot com bubble, right? Everyone knows about the story of the stock market crash in .com, or the Great Depression, or the global financial crisis in 2008, or what have you. You want to buy when stocks are down, but you don't want to buy when they just first start going down, right? You don't want to buy stocks when it's down 20%, and then you buy it, and then it goes down another 50.
So you
So
think
that's
it
what
could
we
go
do.
down another 50?
Um, I, I would say I would more
Put
likely
your
bet that that's the
money where
case.
your mouth is, Tom. Put a stake in the ground, draw a line in the sand. I want you making a definitive, declarative statement. You got the predictive knowledge of the markets. Is crypto crashing down much further?
I see Bitcoin going down to between 20,000 and 10,000, 10 and 20,000,
I wish I didn't ask. All right, Tom.
and
At the end of
soon,
all, what?
and soon,
And
like
soon.
by April.
All right. Oh, all right. And somehow, we're going to end this by letting me know how I can profit from this crash, right? Crash proof is not just the sky is falling, but it's how you might profit from the sky is falling.
Exactly. So it's going to be those people who, right? There's people who don't have crypto and looking to get in, and people who have crypto and need that money to survive, so they need to sell, or people who can hold through it to give them hope that the crypto will come back up to the level that it was now and higher. And so those three types of people are the people we're talking to.
All right, Tom, I'm ready for your goddamn charts. Give me those charts. Show me those charts. Let's do it.
All right, so we're going to start here, and we're going to talk about let's talk about the yield curve. Um, Actually, Peter, just give me 1 second. I see the screen is green on my side, so I just want to make sure that everything looks good.
It
Perfect.
looks good. I'm seeing this beautiful blue chart here. Doesn't look green to me at all. I see up and down and up and down and up and down. So I can predict that the next thing that's going to happen is up.
So we're actually going to start here with the federal funds rate. So what the federal funds rate here represents, this is the interest rate set by the central bank of the United States, the Federal Reserve, for short term debt. So what does that mean? Well, there's the government issues bonds, right, and banks issue loans to people, and there's a certain interest rate, which is the amount of extra money that you have to pay on top of your loan. So if you borrow $100,000 from the government for 2 years, and they say they're going to give you an interest rate of 2%, then at the end of that time, you're expected to get $100,000 back plus your 2% interest. Right? That's the fee you get for lending out your cash. And the higher that interest rate is, the more that represents that the the person who's lending is trying to solicit people to borrow from them. They're offering a higher and higher price. Um, does that make sense? Let me say this in a different way. The If an interest rate is 0%, that means if I lend you money, I get all I get back is that money back. I don't make any profit on that money, right?
Mhm.
If interest rate is 5%, then um, uh, I'm incentivized to find people to lend money to because I want that extra 5%. If I'm just sitting here with my cash, that's not doing anything. That cash is not giving me any money. It's just sitting there. My $100,000 is just sitting there. But if I'm able to lend it out and get 5% back, well, my cash is working for me,
You're
right?
talking about from the bank's perspective.
Just in terms of interest rate, just in general, the idea of having an interest rate.
But let's say I have $100,000 and I'm loaning it out. Do I get interest rates? Like, how does?
Well, I'm just saying, let's say it was just between you and I. If you
Oh,
wanted to
yes.
borrow $100,000 from me, then I'm going to charge you an interest rate
Gotcha.
because I'm risking my $100,000 that I'm giving to you, that I'm lending to you. I
Hmm.
expect to get that back and to be paid for the time that I didn't have that money,
Hmm.
right?
Gotcha. Yeah.
And so let's say there's two people, person A and person B. They each have $100,000, and person C wants to borrow, right? And person A and person B, they both have an expectation that this person's going to pay back this money, and so they want to lend that money out to that guy, right? Well, if I'm person A is offering 5%, what do you think person B might offer? A higher, equal, or lower interest rate?
Higher.
They offer a higher interest rate. They're trying to solicit it, right? But there's a limit to how high that interest rate will go, right? They might bid back and forth, but they're not going to offer a 200% interest rate, right?
Hmm.
And so there's a cap, there's a limit to where that'll go, and the interest rate settles around that price. And this interest rate exists for
Wait, the
any
person
type of
who's
lender.
borrowing wants the interest rate to be low, no?
The person who's borrowing wants the interest rate to be low, exactly, but they don't get to. It's a balance between. So the it's a negotiation, right? The person borrowing might say, 5% is too high. I'll how about 3%? And then the lender might be like, well, 3% is too low. How about 4%? And then you settle on the price.
Gotcha.
And so anytime and so you can imagine there's a pool of lenders and a pool of borrowers. And so there's a interest rate at which it gets settled at. That just as far as how market dynamics work, supply and demand works. Well, what happens is that the longer you lend your money out for, the more the more interest you want to earn, right? Because you have your money's out there longer. You're taking more risk that something might happen to that person, or they might not be able to pay it off, or what have you. And so, the further out in time that you lend your money for, the length of time that you lend your money for, also modifies the interest rate. Does that make sense?
Yes.
So, if I lend out money for 2 years, and I'm asking for 2% interest rate. If I lend it out for 5 years, I might ask for three. If I lend it out for 30 years, I might ask for five. And the difference there, there's a difference there for short term, medium term, and long term interest rates, right?
Yeah.
So generally, what financial institutions do that lend out money is that they will there's an interest rate being provided, long-term interest rates, usually in this case from the government. The government issues bonds, and they have bonds that go out to 30 years. Some countries have bonds that go out to 100 years. And so what the financial institution does is that they will buy long-term bonds, right? Because it's safe. In fact, the U.S. Treasury is considered the risk-free money that the government everything will default before the government defaults on their bonds, and so they'll borrow out, get the high interest rate, and then when they're lending new money out at short term, 2 years, 5 years, what have you, they are uh, they're expecting a certain interest rate back, but they know there's a certain percentage of people who will default on the loan, who won't pay back that money. But there's a cushion between the money that they're going to get, the interest rate they're going to get from the long term uh, debt, the long term interest rate, and the
Mhm.
short term. And so that buffer, the wider the spread is, the wider it is between the short term rates and the long term rates, the more risk the lender can take because there's more of a cushion there. Does that make sense?
Yeah, and so a bond is a loan that you're making to the government, if I'm not mistaken,
Exactly. In
and
this
the
case, it's the
interest
government. It could also be the companies, but we'll talk about the government.
rates are set by who?
So the interest rates are set by the market, right? In general. But short term interest rates, and this is where it gets interesting, are set by the central bank. Now, the central bank doesn't set the interest rate exactly, and then everyone has to follow that. But when the central bank sets an interest rate, they become one of the central bank is one of the players inside of the market, and so if they're setting uh, they're when they set the interest rate, the commercial banks tend to follow that. Well, actually, it happens the other way around. Banks. Let me put this in a different way because I don't want to get too deep in the weeds. What usually happens is that the central banks follow what the market says. So the market says, "Look, uh, we need to raise interest rates, right? Because people to solicit people to borrow from us, so we're raising interest rates, and so the central banks raise their interest rates to match." And then when the market says that no, we don't want to lend out more and interest rates come down, the central banks modify their interest rates to match that. There's all kinds of different reasons for that, but the central banks are responding to the supply and demand mechanics inside of the market. So the reason this matters is that the chart we're going to be looking at in a second is the interest rate set by the Federal Reserve for short-term loans, short-term bonds. And so, you wanted to say something?
Yeah, I just want to be clear on one thing. When the interest rates go up, that's I thought that was to incentivize bankers to lend out money as opposed to incentivizing people to borrow money.
Well, there's two schools of thought that we won't really get into about that. Some people say that when interest rates go up, it means that financial conditions are tighter, which means there's not enough money moving around, and other people think that it's looser. What the Federal Reserve thinks is that, and the broader financial markets think, is that when they increase interest rates, that it reduces lending.
But isn't it more accurate to say not that higher interest rates incentivizes people to borrow, but higher interest rates incentivize bankers to loan?
Not exactly. That's why I didn't want to go too deep in the weeds because they are only the interest rate that is increasing is only modifying the short term, right? The long term rates are the Federal Reserve can't modify that. So let's say the long term rate is at 5%, right? And the short term rate for the moment is at 1%. There's a 4% spread between the short term and long term. So when the Federal Reserve increases their interest rate, the spread is actually getting smaller, right? And that's the cushion that the financial system needs in order to lend out. So what happens there is that it actually reduces lending. So the Federal Reserve increases
I
the
guess
interest
what
rate.
I hear what you're saying, Tom. It just sounds like you're talking that it incentivizes or de-incentivizes the banks to loan. It's not incentivizing people to borrow.
Well, it no, the only when they cut interest rates does it increase
That's right.
people's propensity, yeah, to spend or to borrow.
Gotcha. Gotcha. All right.
So the yeah. So we're going to take a look here. We're going to switch here to the historical chart of the federal funds rate. I only have it back to 1955 here, and so
Only.
you'll notice that we have this sort of ebb and flow. It's sort of like the sine curve that goes up and down and up and down and up and down. We won't really go into the details as to why um, the interest rate over here from 1955 to 1980 went up. That has to do with there was massive inflation in the 70s and 80s because of the baby boomer generation, the largest generation of children coming into the workforce, and so there was all kinds of different dynamics there that made it so prices went up. But what's interesting here is that since then, since the 1980s, the interest rate has only gone down, right? So these ebb and flows that we see here, these troughs and peaks, represent a cycle, which is what we're talking about when we're talking about the financial markets. We're looking at long-term trends and we're looking at cycles in the same way that you would look at weather patterns to figure out when it's a good time to plant or when it's a good time to harvest.
These
And
interest
so,
rates that are going down, is this short term or long term?
while the federal funds rate only affects the short-term rates, so this is the shorter-term rate.
So this short-term rate going down means there's a higher spread between the long term and the short term, which means it's an environment where money is
More
more
free
available.
flowing. Yes, more available, exactly. So in general, over this trend from 1980s till now, monetary policy has been in general loose. They've been putting more money into the system than they take out. It's this ebb and flow, this back and forth. But every time you'll, like we saw in the chart, it keeps getting lower and lower, lower highs and lower lows. It means that whenever the Federal Reserve started increasing interest rates in order to tighten conditions in the economy, and they never went as tight as it was in the previous high.
Hmm,
And when they cut to make financial conditions looser, it always went looser than it was in the previous low, all the way to the point
interesting.
that now we're at the zero interest rate.
My
So now they
goodness.
can't really cut anymore unless they go negative.
They'll never go negative, Tom. Never gonna happen.
So just remember here, when the line goes up, financial conditions are tighter, and when it goes down, financial conditions are getting looser.
What a chart technical way of putting that. Economic. There's more money flowing, less money flowing, tighter economic conditions. Is that the
Well,
way you think about the world now, Tom?
I don't want to use those terms because that's the term they use, and that's the terms you'll see in the
Yeah,
news articles and all that. So you got to know
I get it.
what they're saying out
Of
there. All
course,
right,
of course.
we don't want to be in a situation like I was when in high school. I went to high school in French, and then when I went to college in English, I couldn't understand anything they were saying.
Yeah, that's
I don't
right.
know.
That's
And,
right.
get your protractor out. What the hell are you talking about, Teach? So just a quick look here. We're going to look at the bond yield. So what we just saw before was the Federal Reserve interest rate. What I'm showing you right now is the long term chart of U.S. government bonds. The red line is the 2-year interest rate. The yellow line is the 5-year. The blue line is the 10-year, and the purple line is the 30-year. And so you notice, just like the federal funds rate since the 1980s, it's been going down and to the right. But you'll notice that the purple line, the long-term interest rate, doesn't move as much as the short-term red one, right?
Mm,
So here, the purple one is the purple one is fairly steady here, right? Do you see that there?
I do.
But the red one goes down and up,
Gotcha.
right? Um, so then we have a difference between the red line and the other lines. And so when we take the difference between that, that's called the yield curve. The yield curve is the difference between short-term interest rates and long-term interest rates. So we're going to jump to the chart here, which is the yield curve. This is the difference between the 2-year interest rate and the 5-year interest rate. And it goes up and down. And this represents the business cycle. Now, people have made a lot of money on this chart, following this chart over the years, because when you get down to, actually, let me show you over here. So do you see this red line now at the bottom of the screen?
Yes.
So the interest rate, when it gets down to this red line, it means that uh, when it crosses, it means that the yield curve has gone negative. That means that since this is 5 years minus 2 years, it means that the short-term interest rate is now higher than a long-term interest rate, which is squirrely. Like I told you
Mhm.
before, you would expect that the person longer term has a higher interest rate because they're saying, "Well, I'm taking more risk because I'm letting out my money longer, and so I need a higher price. You need to pay me more in order to get that money." But when financial conditions get so bad that lenders go, there's not enough lenders in the market, and the short term rates go above long term rates, that means there's a problem. That's an indication there's a problem in the system, right?
So normally short-term rates are lower than long-term rates because the longer you lend money out, the greater the risk.
So
So
when the
if
short-term
it's
rates gets high,
short-term rates is higher, that means there's more risk for short-term?
yes, for some reason, the lenders in the short term are saying, "No, I'm sorry, you're gonna have to give me more now than later."
Oh
So
my
people go, "Wait,
god.
so it's better for me to borrow 5 years out than 2 years out?" Yeah, for now. And the idea there is that anyways. So
Has
as
this
you can
ever happened
imagine,
before?
it happens all the time. So whenever this yield curve here crosses down, whenever you see this blue line cross down past this red line, it means that's what's happening. That at that
Inverted yield
period,
curve. Hmm.
yeah, at that period, the yield curve has inverted, and there's a problem. In fact, it's so reliable that usually between 6 and 18 months after the first time the yield curve enters this red area, we have a uh, recession. I'm going to show you the recessions now on the chart.
Say that again.
And
16 what?
6 to 18 months after the yield curve goes negative, we usually have a almost like I think it's like a 90% accuracy or 95% accuracy that within 6 to 18 months we're gonna have a recession.
Hmm.
Oh, I should ask. Do you know what a recession is?
Yeah, a recession is when I go to the grocery
A
store
recession
and
is when you have 2 consecutive months of negative GDP growth.
That
That means the
that's
growth
correct.
inside of the population in the country is negative for 2 quarters. This
Two
is bad,
quarters.
Peter. It means productivity is coming down. It means unemployment's is going to start going up. It's people are going to buy less stuff. There's less borrowing happening. It's
Great time to quit your job.
worst time to quit your job. Consider that to be the fall headed to winter, right? So as you notice here on the chart, do you see here the red bars behind these
Yes.
here? So those are recessionary periods. So we have the dot-com crisis over here in 2000. So right here in 2000, we have the dot-com crisis. We have the mortgage crisis in 2008. We have COVID in 2020, which is pretty interesting. Here, the yield curve inverted in January 2019,
Hmm.
and you're like, well, it inverted. How did it predict the COVID recession? Economic
Res-
data. Economic data,
it's
aggregated
spooky,
economic
Tom.
data is super spooky. Exactly.
No, it was a coincidence.
Well,
How could it how could it predict COVID?
well, we've talked about this in terms of the fourth turning before, that the an event can occur, and if that event had occurred, the COVID had occurred at the beginning, like we had come out of a recession and we're expanding, yield curve is going up, things are looking better for the economy. We would have absorbed that shock better.
I see.
But what it was indicating there is that the COVID shock came exactly at the wrong point. It came when things were already bad, and so it made already bad things worse.
So, what do you think? If COVID didn't happen, would there have been something else that would have caused the reception? The recession?
Naturally, we would have already gone into a recession. Now, you have to understand, recessions and expansions happen automatically within any given system, right? So, the short version of this is this. So you have an economy, and then you have what's called a supply chain, and so that supply chain is all the way from growing things on a farm or mining things inside of a mine or what have you, and those base materials then get taken out from there, and they're sent to people who process it into oil, into different types of oil that are used for plastics and stuff like that. Processing food, processing wood into slabs. You're processing that. You're cutting stone. You're preparing that. Then that goes off to the producers, people who actually produce that and turn it into jewelry, turn it into chairs, turn it into what have you. Who then sell it wholesale to retailers who stock up, and then they sell it to you at the store, right?
This
So
is a
that
supply
is
chain? Is that what
the sup
you're
exactly. This is a supply chain. And so, what happens is that that whole process can take 6 to 18 months. And so, what happens is that if there's a problem, let's say there's less lending, happening. Let's say for some reason there is, well, there's all kinds of ideas that come to mind, but let's say there's a problem with lending to the people at the beginning of that chain. The new miners can't get enough money to. Um, Actually, let me put it in a different way. At the end of the chain, the retailers and wholesalers have inventory stock that they've purchased, right? And so the retailers might have hired a bunch of new people in order to sell the stuff, right? They hired more restaurant people, they hired more laborers inside the factories or what have you. They hired more people in order to sell this inventory or to provide these services. Well, at a certain point, the number of people in that cycle who are going to buy those products, they've bought it already, right? They've bought the
Mhm.
chairs, they bought the new beds, they bought the what have you, and so the rate at which they're buying slows down. And as the rate at which they're buying slows down, the profit margin of the retailer or even the wholesaler decreases, and they might still have inventory, right? And so then they start laying off people or not hiring people at the same rate, and so unemployment goes up, and then it keeps going until so now they're no longer ordering new inventory to replace the inventory that they're selling. They've stopped buying inventory from the wholesaler, right? And so the
Mhm.
wholesaler has stopped. Um, uh, their orders to the producers have also gone down. And then those producers say, "Hey, wait, we don't need as much materials," and so mining goes down and growing goes down. It slows it. It's the slowdown goes up the chain, right? Then it goes. Usually, what happens with people is that they literally extrapolate, and then um, they stop ordering too much, right? And so what happens is that then
You mean they overcompensate?
they overcompensate, exactly. They overshoot it. And so it slows down more than it necessarily must because it's just this momentum of decrease in sales and inventory purchasing and growing and all that sort of thing.
Mhm.
So then what happens? What happens is at a certain point, the inventory that the retailers and wholesalers have built up gets depleted, right? And as it gets depleted, so as supply comes down, so the demand came down first. So as the demand comes down, the price has to lower, right? And so at a certain point, the price comes down to a point where it matches demand, and then now the demand starts to increase. And as the demand increases, there's not enough supply, right? And if there's not enough supply, well, then the price starts going up for those goods and services. And as the price keeps going up for those goods and services, other people who can make those provide those goods and services start doing that. And so they start putting in orders. Hey, we need more of these chairs. We need more of whatever it is, and they send up the orders down the supply chain or up the supply chain, and then the wholesalers do more. The producers, the growers, all the way up to the base materials, and so they start overcompensating the other way. Oh, let's make as much as possible, and then this starts again. So the inventory cycle, how much inventory, which is one of the metrics that you can follow in the economy, tells you gives you a nice lead indicator for what might happen 6 to 8 months down the line, and it's the trend of it, right? It's the trend of what is the ebb and flow, what is the rate of change of the inventory for any given industry.
And is that
That
the
make
business
sense?
cycle?
That is the business cycle, exactly.
Well,
And
so
so if you
if you
pay
had a
attention to this, you can
central
make money.
you could what? You can make money, you said?
There's people who make money off this inventory cycle, right? They can see this ebb and flow, and if they have a specialty in any particular industry, they know when to buy things low, when to buy things high, how to cut a deal, and take advantage of this, or to buy stocks in companies that are at the bottom of the business cycle, because they know, well, over the next period of time, over the next 18 months, a year, 18 months, that the stock for this should go up as more people are purchasing products from this company. Their earnings will increase, and so just like that, you can earn money 5 to 7% per year just following the inventory cycle.
It seems to me that if we had a central planner, they could get rid of this business cycle, smooth everything out, stop with this overcompensating in this supply and demand thing, and the price would just stay stable for the rest of our lives, Tom.
So enter the central banks, right? So the history of the central banks is long and storied. I'm not going to go into all the details about that. You can read a book called Lords of Finance. Very interesting. Well, very extremely boring if you're not interested in the history of the central bank. Super dry, super dull. But if you are,
Extremely boring almost sounds entertaining. Like, you know what I mean? If you somebody told me this movie is extremely boring, I'd be like, I gotta see this movie.
well, it's very insightful, and you're not going to find a lot of books like that. So it's really pretty cool.
Lord
But
of
if eventually the central banks came to the conclusion that what they can do, well, what would happen is that I talked about that inventory cycle as if it's nice and easy, but shocks to the system can really destabilize it. And one of the shocks that would happen is that you would get these bank runs, right? So people would be like, "Oh, I'm not sure what happened. Something, let's say something like COVID happened, or it doesn't have to be to that magnitude, but any shock within a given population, and then really disrupts the inventory cycle, and it disrupts credit, and it disrupts people's trust in banks or what have you, and then you would have these runs on banks where people go, "Well, I need to take all my money out," but the bank doesn't have all that money. The bank then collapses, and then the economy in that given area goes down, because where you gonna borrow money from if not from the people who have money, because they don't have any money
isn't
to
that what
borrow?
happened during the Great Depression?
No,
Oh,
the
never mind then.
Federal Reserve caused the Great Depression, but let's not.
Blasphemy.
A number of reasons, but before that, before the central banks were around, you'd have bank runs and then collapses, and if one or a couple of banks in that area fell, I mean, you see, no, It's a Wonderful Life. It can really destroy a town. The panic can really destroy a town, and so the central banks decided, well, they can guarantee the money in the bank, right? So if there's not enough money, they could send money there, and they could insure the deposits at the bank, and so you didn't have to really worry that your money was going to disappear, right? It used to
Mhm.
be that choosing a bank was like trying to choose which cell phone you wanted to use. You'd really have to think about what are the features you wanted, what are the risks, how long term will they support this, blah blah blah. But then it became more just a utility. Now we feel comfortable just going with any bank because it's guaranteed by the government to a certain amount. Not a good idea, but whatever. That's what people do. So
Sounds like a great idea to me. Sorry, go ahead.
central banks decided that if they, by modifying the interest rate and modifying the amount of money flowing inside a system, they can, on an expansion up, continue that expansion, and on a dip, they can, when they saw a recession, they could, compensate for people the momentum by sending signals to the market that, oh, things are better than they thought. So then people would spend and borrow more money than they would have otherwise. And so that's how you end up in this thing. I mean, it would work fine if it's sort of like, if you have a credit card and you spend the money on the credit card and you pay off the credit card, then that's fine, right, Peter?
Mhm.
You spend the credit card, you pay off the credit card, and you use it when you need to. Great. So it can make you good times better and can help you in bad times by having a source of capital. If you spend the money on the credit card and then you take out another credit card in order to pay the interest on the previous credit card, and you keep doing that, well, Peter, it seems like you have tons of money, doesn't it?
Free money, baby.
Free money. You're like, tons of money. I just had to get new credit cards, and I could always get a new credit card because the next credit card, the interest rate will be lower than the one before. And if I just keep getting credit cards with lower interest rates, I could keep paying off the debt that I've accumulated. Well, we all saw what happened in the subprime mortgage crisis in 2008 when you have just a series of dominoes of debt. Anyways, yield curve. So this squiggly line is going up and down and up and down, represents the business cycle. So when like you said before, when the line is going up, it means that more money is flowing into more lending is happening, and so more money is being created. Remember, the spread between the short term and long term rates is increasing, and when it comes down, it means things are headed towards badness until it inverts, crosses the zero, and then 6 to 18 months after that, you usually have a recession. Great. We
I
overlay that
understand
with
completely.
the. Ooh, one second. Let me just take these guys. We overlay that with the federal funds rate, and you'll notice that the federal funds rate in general is the inverse of the yield curve, right? So
I can
interest
see that.
rates,
Yeah.
right? So when interest rates are falling, remember we said that when the Fed funds rate is falling, it means financial conditions are what?
Say that again.
Loosening. Loosening, exactly. When the Fed funds rate is coming down and they're cutting interest rates, it means that the financial conditions are getting looser, right?
Yes.
Because the spread between the short term and long term is getting wider to encourage lending, right?
Oh, I
And so the yield
understand.
curve
I
goes up.
understand. Yeah.
Perfect. Now, let's take a nice little notice over here that before, between 1989 and 2008, it was basically uh, com- just completely inverse. Let me actually flip this so you can see. I just flip it. They match, right? The yield curve and the federal funds rate. But as of 2008, after the global financial crisis, where the world changed,
Wait, I'm sorry. Hang on. The yield curve is the difference between the long term and the short term
exactly.
interest rates, and the other thing you said was the funds rate. And
The
what's that
federal
again?
funds rate is the interest rate set by the central bank of the United States. And they're trying to modify the short term rate. So when they're increasing the federal funds rate and it's going higher, they are shrinking the difference between the long term and short term. They increase interest rates to shrink that spread to make people borrow less money, to
Gotcha.
slow down the system.
And they're
And when
not. forcing the situation. They're not setting it, but they're influencing the market because they're a major market player.
Exactly. They're pretty much forced in the short term.
All right.
Not fully, but pretty much. And what's interesting on this chart here is that as of 2008, you see how 2008 the yield curve, sorry, not the yield curve, the federal funds rate is 0% basically. That means the cost to borrow money for large players was zero or near 0%. What does
Well,
that mean, Peter? What does that mean for financial conditions?
it means it's loosey.
Super loose. Super loose. And so tons of money was sloshed around the system. And in fact, this period from 2008 to 2016 was the longest period of expansion on record for the United States. Just
Hmm.
massive amount of money being pumped into the system.
Just keep
And we
that
notice
going,
here,
man.
sorry?
Why didn't
Well, they
they just
tried.
keep that going?
Well, they tried. So notice here how the yield curve peaked over here in 2010.
Mm-hmm.
And it was coming down. So this coming down over here was headed towards a recession, right? Once across this line, we would have had a recession 6 to 18 months later.
Mm-hmm.
But something happened over here where it was averted and the line started going back up, right?
Mm-hmm.
Enter the third thing that modifies, that we're going to talk about, that modifies financial conditions, which is QE, quantitative easing.
Yeah, boy.
All right, Peter. So give me the dictionary definition of quantitative easing. Go.
Quantitative easing is
Quantitative
the
easing is
euphemism.
when the Federal Reserve, in lieu of cutting interest rates because they were already at 0%, they can't cut it anymore unless they want to go to negative interest rates. And we saw what happens out of Europe when you go to negative interest rates, where you lose money if you save money. What they would do is that the Federal Reserve, through all kinds of different machinations, would actually buy debt off of banks' balance sheets. They would buy debt. They would buy the debt because, as you can imagine, a bank needs to have. They can't just lend out an infinite amount of money, right? They
Mhm.
When you deposit money at the bank, they have access to that gives them ability to give out loans because on their balance sheet they have an asset, but they're constrained. There's a certain amount of a ratio between the amount of assets that they have and the amount of loans that they can give out. They have to have what's called a reserve requirement, that this is the amount of money that they should have on hand or assets on their balance sheet in order to be able to lend out X amount of money. And so, in order to encourage banks, because they couldn't cut interest rates anymore, in order to encourage banks to lend out, what they would do is that they would buy liabilities, or not liabilities, they would buy assets on the bank's balance sheets that don't allow them to lend out more money. Like this was just assets that they have, but it wasn't anything you could lend against. They would buy that, put that on their balance sheet, the Federal Reserve on their infinite balance sheet, put it on, and buy it with empty money, just new money. They would just buy it from the balance sheet of the banks, and now they have what's called a reserve asset. It's like money that's only good in that it allows banks to lend out more than they otherwise could have. Does that make sense?
Makes sense. I mean, doesn't make sense, but it makes sense.
Well, the Federal Reserve is just buying it with what? No one knows.
That's the part that, yeah.
Exactly. So that's the idea of money printing, right? Quote unquote money printing. It isn't really money printing in that way because the money that's being put inside of the banks can't go out and buy gas with it. They just can't go buy anything with it. It's just there to allow them to lend out more than they otherwise could have. That's it. Right?
Right.
And so what happens is that on our chart over here, you'll notice that once so over here, where we were headed towards a inverted yield curve and then eventually recession. Money is printed into the system over here.
And this money printing quantitative easing started in 2003.
It started in 2008. Well, it really started in 2003, but it really picked up in 2008. But anyways, it really started in 2008. That's when
Well, talk
quantitative
about
easing
picking
started.
up. So they had to do that because of the financial crisis. I
They
see it
had to do that
shooting up
because they
there.
cut interest rates all the way down to 0, and so they couldn't cut interest rate anymore in order to stimulate economic
But
growth.
why did they feel they needed to stimulate right then? That's not during the crisis that Obama had to deal with?
Yes, I mean, they feel the need to have to stimulate because, the world's in a recession, and so
Oh,
our economy is based on consumers. Like, consumers have to buy in order to, or actually, consumers have to borrow money in order for new money to be created in the system. We're a credit-based economy. Um, what's the
I get
simplest
it.
way of putting this? Yeah,
No,
so
I get it.
if people don't borrow money and spend money, then there's no churn within the economy, and if we have a slowdown in that for too long, then we end up in a crash because the loans get defaulted on, and when loans get defaulted on, Peter, it's like that money and all the money tied to it that was created from the spiraling out of that, the pyramiding of debt disappears. So you actually get the money supply shrinking, right? And that's deflationary, or what they would call disinflationary. So that's bad. The Federal Reserve wants more money flowing around and assets to go higher and real estate to go higher and stocks to go higher. Why? Because it causes money to from outside to pour into the United States. The better your assets do in your country, the more outside money pours into it.
Sounds like you're making the case for money printing go brrr,
Well,
brrr.
they certainly make the case for it. And so you'll notice here on the chart, while rates are federal funds rates are at 0, they keep buoying the economy. But you'll notice that the highs get lower, right? Lower highs means that the money that they're putting in is not doing as much as it did before. So it's a ticking time bomb. Eventually, they're going to put money in and it won't do anything. But that's neither here nor there because that's not what we're talking about. We're not talking about the eventual collapse of the financial system, which will happen and is scheduled for some period within this tribulation or fourth turning. But what is interesting is actually let's take a look at how this reflects with the stock market. So the S&P, you know what the S&P is?
The
The
S&P.
S&P 500 is an index of stocks of the larger stocks that are publicly tradable on the U.S. stock market, and so it's a nice proxy for how the market in general is doing. It includes tech, it includes energy, includes commodities, it includes a bunch of different things in a smatter of different things. The big players in that space, and so you'll notice here on the chart, I'm showing the S&P in white. So the S&P, it's been climbing. Basically, it's been going up and to the right ever since the stock market, the data we have here since the 70s, but ever since the stock market was open. But we have these ebbs and flows. This peak over here that we're seeing was the dot-com crash. Over here, this is the crisis, the global financial crisis. Over here, this is Brexit and the Greek debt crisis. Over here is COVID. And oh, look at this. Looks like something is rotten in Denmark.
Oh no.
That's right. So the question is, what's going on over here? So
So this is one of those indicator things where, we talked about the market. The reason we like these charts is that it kind of gives you signals and predicts. These are market indicators that can kind of predict the conditions that are to come. So when we look at this little dip here at the end of this white line, it which is indicating a drop, a recession is coming. This is why a chart like this is useful for you.
exactly. So you've probably heard people talk a lot about buy and hold is the best strategy when it comes to stocks, right?
Buy and hold.
Yeah, they're like, oh, don't trade, buy and hold the stock.
Oh yeah, because you
Uh,
buy it and it goes up,
and it
guaranteed.
goes up and to the right.
Yeah.
Yeah, that's true, depending on where you buy it, right? So let's go back to the chart over here. If you take a look at the stock market, if you bought the Nasdaq, sorry, the tech stocks at the height of the dot com bubble, anywhere between 1998 and 2001, if you bought here, well, it took you until 2008 for the prices 2007, 2008 for the prices to get back to where you bought it before.
Was that 9 years, 8 years?
Exactly. So that's 8 years. That's pretty garbage, right?
Hmm.
Obviously, if you bought it over here in 1994, then you're happy, right? Even if you sold it at the lowest point of the dot-com crisis, you still made money. Now imagine the guy who buys stocks over here, or the generation who buys stocks at the top over here in 2000. They have to wait till over here, 2006, 7, 8 to get back to break even, right? And we know that that break even is not even break even, Peter, because $100,000 in 2000 doesn't buy the same amount as $100,000 in 2008. Even just in counting inflation, right? Inflation is the rate at which the money supply increases. And so, if your or what your money buys now versus what it did before, and so let's say for the sake of our argument, we take the government data and say inflation is around 2%, right? Or that's what they're targeting, 2% inflation. Well, that means if you hold $100,000 in your bank by next year, it can only buy $98,000 worth of goods, right?
Right.
And so, and that's compounded per year. And so the if you bought stocks at the top of the dot com bubble, and then you're like, okay, I'm back to break even at the right before the mortgage crisis in 2008. Well, you're not at break even. There's inflation every year. So
Hmm.
your money's even less. So that you're in a poor situation. And then let's say you still bought you still held, and then the stock market dropped again. Well, it was only in 2013 that you got back to break even.
Oh my God.
So the person who invested, their retirement or their nest egg or whatever investment they put at a dot com crisis near the top, it took them until 2013 in order to make their money back. Oh, not even just to get to nominally break even and not really even break even because of the inflation. In fact, it was actually a little bit later on in 2016 that they would even been in break even territory. So buy and hold. I mean, it frustrates me when I see YouTube videos that people go, "Oh, just buy and hold the index stocks," and you go, "Okay, but when?" It's like people telling you to plant your crops in November. It's like now's not the time. All right,
But if you don't
buy
know
and hold
these
them
charts,
super
then you
exciting.
don't know when the right time is.
Exactly, super useful to know that. And so you'll notice over here that the um, let's take a look at over here. So we see here in from 1993 all the way down to 2000, the blue line is going down and to the right, right? And the blue line coming down means that financial conditions are tightening. This is the yield curve, right? The financial conditions are getting tighter and tighter and tighter and tighter. We see that it inverts here in 98, and then 18 months later, stocks crash, right?
Hmm.
So the idea is that if you bought stocks before, you would just every now and then, every month or so, pay attention to the yield curve, and when you saw the yield curve invert, right, you would wait a certain period of time, wait a few months for the momentum to sort of continue, and then you would sell your stocks. You would just sell.
Hmm.
And you go, oh, but Tom, what if the stock market keeps going up after that? Okay, that's fine. Then you miss out on those gains. But what happens if it goes down? Right? That's what you want to guard against.
And the game in the
Uh,
stock market is not about how much you can make; it's about how much to not lose.
exactly. Same thing over here again in 2000. The stock market bottoms in 2003. Financial conditions were started to tightening over here again. So the blue line's coming down, right?
Hmm.
And then the yield curve inverts over here in 2006. So the idea is that okay, great, it inverts. Don't panic, right? You'll notice here that every time it inverted, the stock market panicked like that period for that period of time. It
Hmm.
inverts over here, and the stock market is panicking here, even over here. Don't do that. Don't panic as soon as the information comes out. Wait for the momentum to cross. You'll notice here that after it inverts the first time, it usually needs to invert again afterwards. It goes deeper negative, right?
But you've told me you've told me in the past, if I remember correctly, that you don't want to try to time the peak because you will never get it, and if you do, it's luck.
Yeah. So what you do here is that maybe on the first inversion, you sell half your position, half the assets you have, or whatever. I'm just saying you don't overreact because in August, 2 weeks before the end of August, it got cold for a little bit.
Mhm.
You go, okay, right. This reminds me that winter's coming and that I need to actually pay closer attention week by week as opposed to month by month or quarter by quarter. That's all I'm saying here.
Gotcha.
You can't time necessarily the day, but it gives you I mean, so far, aren't you seeing that it's giving you a pretty general indication of what to look for?
Yeah.
And over here in before the mortgage crisis, you've probably seen heard about the movie The Big Short and people who had made money on the collapse of the system because they were paying attention to stuff like this. They could see that the yield curve inverted over here, right? But if the yield curve inverts over here, and this is when you sold your stock, or this is when you panicked, or this is when you shorted the market, or whatever, there's tons of people who lost tons of money as the stock market kept going up. If you
Mhm.
watch The Big Short, you'll see that it was a Michael Burry was like bleeding millions and millions of dollars as he was waiting for this collapse to happen. He went too early, right? So then the stock market rolls over and falls again. And then we see the same thing over here. Last time it inverted, the stock market, the yield curve inverts. That's not the time to leave, right? We have a panic here, what's called Volmageddon. Anyways, neither here nor there. Very interesting point in the financial history, but we have a dip, and in this dip, you could have panic sold, right?
Mhm.
Right? Not necessarily the best idea because you know that this momentum that carries and the time to get out of it was the second time, or as it inverted again, and this would have been the perfect time to get out, right? And then
Tippy
boom,
top.
recession happens. And so right now we are headed again towards this line. We see that the yield curve is headed towards that line.
When you say headed, it looks like it's dropping off a cliff.
Exactly. Yeah,
Are
it is
we
dropping
not
off a
there?
cliff.
What time is it? Are we there yet?
No, not yet. I mean, pretty soon though. Pretty soon we're going to get there. But don't over here, the person who thought that the yield curve was headed to negative and now it's time to short would have been way too early, right? Sometimes
Mhm.
you can get a bounce in the yield curve.
You want
You
to
don't
wait
want to
till
be
it
too early.
crosses the line the first time.
You actually wait. You actually wait till it gets down there.
Not financial advice. Just going to
Not
throw that
financial
in
advice.
there.
I'm
There.
just saying that's what I would pay attention to. All right.
Yeah.
All right. So, what does this have to do with Bitcoin? Well,
What does this have to do with Bitcoin?
let's take a look at a Bitcoin baby. Bitcoin's over here in orange. All right.
All right.
So Bitcoin, we only have data that starts in 2012. So unfortunately, we can't compare all the past data, and even more unfortunately, Bitcoin started in the middle of this big pump and dump season over here, right? So the yield curve is the interest rate stayed flat. So this was the period I said with the most money, the largest expansion ever on record for the U.S. economy. Oh, Bitcoin comes out and launches out of the gate. It goes from freaking $2 to $900. Pretty spectacular. That's when Bitcoin starts to get on people's radar. But now let's take a look at these patterns. Now, so far I haven't been showing you any type of math here, right? We're not doing any sort of calculations. We're just taking a look at the shape of these curves and how they relate to each other, right? Pretty simple, right? You don't have to be a meteorologist in order to be able to take advantage of trends in the weather. You can make decisions based on that, right? When I had to choose when I was going to get married, I chose it based on weather patterns. You can do that, and the same sort of things happen in the stock market. So sometimes people feel like, oh, the data is like so obtuse and it's so difficult to understand, and there's so much math involved, there's so many numbers involved. You can actually spend a lot of time looking at financial information and never have to deal with specific numbers, just looking at shapes and relationships.
We haven't done math here today, so and I'm understanding what you're talking about.
Exactly. And you're mentally deficient,
How dare you
so we see
speak
here the
truth?
we see here, so in this period over here, this blue line here is increasing, right?
Yeah.
So we're always going to look at these three things. We're going to look at the yield curve, what direction it's going, the yellow line, quantitative easing, how much money is the Federal Reserve trying to pump into the system, and where is our interest rates set, right? Over here, we have a nice perfect storm. We have not only is the blue line going up, which means more lending is likely, um, and the quantitative easing is happening, so this yellow line is going up as well, and the teal line is flat. So perfect financial conditions for money just sloshing around the economy, just wine glasses spilling, and people don't care. And let's order around on the house. That's what's going on over there, and it just skyrockets up. You see that Bitcoin just reaches crazy highs. Then Bitcoin falls. Then Bitcoin falls over here 85%, right? Now, it's not like it was at the beginning, right? But anyone who bought the Bitcoin around its mania over there, like I said, the buy and hold strategy works.
What price was that?
That was 900. It fell from 900 down to $220.
Oof.
Brutal, right? So, but let's take a look at what we're seeing here. We're seeing here that at this peak, right, or near this peak, the 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 yellow line, the amount of quantitative easing that's happening, is decelerating, right? You see, it's
Mhm.
decelerating, right? And so, if you were to hear a car go, then you know that there's less gas being given to it, and the momentum will eventually cause it to slow to a stop, which is what happened. And as that excess money started going down, we also saw that the yield curve peaked, that it wasn't going up anymore, which means that the spread between the short term and long term interest rates are not getting wider, and so that momentum of increasing lending that's happening starts to decrease. And it's no surprise then that as the gas comes out of the car, um, the wind comes out of the sales of Bitcoin and it sells off. Does that make sense?
Yep.
So the Federal Reserve doesn't. There's no interest rates being cut over here for more money to come into the system. Quantitative easing is slowing down, and the yield curve is falling or peaked. So there's not as much lending. Boom! The amount of the speculation in the Bitcoin market comes out. This is a good point to mention that in any asset, you have the people who are buying the asset for long term holding. Doesn't matter what asset it is, because owning the asset is better to them than selling it. That's true for people who buy stocks because of a dividend. That's true for people in agriculture who are buying supplies, oil and wheat and fertilizer or whatever to have for their farm. They're not looking to sell this right now for a profit. They're looking to have access to this later on. It's true for pension funds. It's true for any number of assets. There's a core of people, a percentage of people who are holding it, who have no intention of selling it short term, and then there's people who are speculating on it. Right? They are anyways, they're speculating. They think a change might happen. They want to bet against the market. They're using leverage in order to get a lot of money in short term moves. Any number of reasons, as speculators. So when money dries up, speculation starts to drop, and those people have to sell, 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 sell. Right? For
Mhm.
all kinds of crazy reasons, they got to sell. They're forced sellers, and they have to sell at whatever price, and boom, the price falls down. And
Hey,
so,
so doesn't it mean that when the uh, wherever it lands, once it crashes down, that floor is kind of like you've gotten rid of all the speculators?
exactly, mostly of the speculators, of all the forced sellers. So over here for Bitcoin, that was around $250 between 2014 and 2015.
So the floor of an asset, especially of a speculative asset, can let you know the strength of that asset.
Exactly. The amount of percentage fall, right? How many speculators got pulled out lets you know what are the people who actually needed this. What price are they sitting at that they're okay to hold that?
Mhm.
But this is given the idea that the asset is still the desire for the asset, the demand for the asset stays stable, right? If you look at Pogs, the demand for Pogs fell off a cliff. So there was no floor in Pogs, Peter. But when it comes to when it comes
I
to
love Pogs. Oh God.
when it comes to Pokemon cards, people play Pokemon all the time, right? So there's always going to be a group of people, or there as long as that demand stays there, you're going to have a floor in the prices. Same thing with comic books or anything like that. All right. Now, then we had uh, after the floor in Bitcoin came in, we were still in the expansion phase, right? Now, even though the Federal Reserve started increasing interest rates over here on the purple line, and the quantitative
Wait,
easing,
what purple line?
sorry, not purple line, the teal line goes up. That means the Federal Reserve was increasing interest rates, which means they were trying to curb um, demand for lending. They wanted less lending to happen. They wanted to slow down the economy. But there was still momentum in the economy because you see here the yield curve hasn't inverted yet. It's not even close to inverting. Like around here, the yield curve is still fairly high. In fact, it's where it was before it bounced off last time. We're not even at inversion yet, right? And
Mhm.
so there's still money sloshing around in the system. There's still momentum, and so that's why we see the stock market goes up, still goes up, and the Bitcoin still goes up, right?
Why is the Fed increasing? Why is the federal rate increasing? Why are they doing that when it doesn't seem obvious that they would do that?
For a number of reasons. Here, I believe that I don't have to go into explaining what the Phillips curve is, but essentially, when we talked about the inventory cycle, right, we said that there's an ebb and flow in inventory, but that also coincides with an ebb and flow in employment, right? And so when you get to maximum employment, where there's uh, the uh, the labor force is maximally employed. I mean, what's considered maximum employment is a whole other story. But let's say if you put up a position for a job and you find it difficult to hire somebody because people are already in positions, you have to offer more money in order to convince someone to leave the job that they're at in order to come to you, right?
Mhm.
Because they're like, okay, well, you have to give me more money for the opportunity. And so what happens is that when uh, the someone's salary is one of the or employment costs or one of the biggest costs for a company and the hardest number to change. And so what happens is that the company who has to pay higher salaries to the employees, well, they're not taking a smaller profit margin. We live in a capitalist society, Peter. They're not taking smaller profit margin. What they're doing is passing on the cost to the consumer, right? And so the prices for items start going up. Prices for goods and services start going up because the companies have to flow those price increases down to you. And so, and generally the population has more and more the ability to pay these prices because they're employed at higher rates, right? Their wages are going up. But what happens is that if that cycle, the idea is that if that cycle were to go unchecked by the infamous central bank, Federal Reserve, that prices would then skyrocket, like we saw, like what happened in the '70s, and inflation would get out of control. That prices with things would keep getting higher, and people would demand higher wages, and the cycle would just continue until prices got out of control, which is ridiculous, but whatever. Um, and so the Federal Reserve wants to stop that. And so what they do is they increase interest rates to increase unemployment. They increase interest rates so that lending happens less and people who are on the margins can't get loans and companies start having to curb their costs and things come down and inflation expectations lower.
Why does the interest rate going up make it so that lending happens less? I thought a higher interest rate incentivizes banks to lend.
No, the
Oh,
higher interest rate decreases
it makes it so
the
people don't want to borrow money.
no, it makes it so that lenders don't want to lend money
A higher
because
interest rates. The interest rate that's going up, is it short term or long term?
always short term.
I see. So the buffer gets, the cushion gets smaller.
Smaller and smaller, exactly.
I get it. I get it. All right. All right. I almost
And it
lost it
costs
there.
more. It costs more and more for companies to the interest rates going up. So let's say as the interest rate was going down last time, they were taking out loans to run their businesses or whatever, to buy houses or whatever it is, and now the interest rates are going up. Well, they can't get and they could only keep that Ponzi scheme going by getting a new credit card with a lower interest rate, a new loan with a lower interest rate in order to pay the previous one, right?
But if it's
And
going
so
up, then they can't
if
get
it's
that
going up,
card.
they can't do that.
Gotcha.
Exactly. And so it's called a debt burden, and it crushes growth, which is what the central banks want to do. They want unemployment to go up. They want things to go bad for the good of the economy, Peter, because otherwise inflation will be out of control. Where would we be if we didn't have the central banks? The central banks have been around ever since mushrooms have been on the planet, which is fairly long time, Peter. So we're gonna listen to their wisdom, and they always get everything right. They never get anything wrong.
That's right.
I have to say that on YouTube, or they'll take down our channel.
Not yet. Soon.
Exactly. All right, so we'll switch back to the chart over here. So you'll notice that Bitcoin is going up, and the stock market is going up. So the stock market keeps going up over here, and Bitcoin goes up. And you'll notice that right around the same time, so Bitcoin peaks and rolls over. Bitcoin peaks and rolls over, and then
What price is
shortly
that?
after, that price is 19,000,
Mhm.
20,000, yeah, 19,000. Rolls over, and right after the stock market does the same. So let's just zoom in here. So the orange line peaks, rolls over. Bitcoin is far more sensitive than the stock market, because the amount of money in the Bitcoin space is less than the stock market, and so and people trade the stock market. Long term holders trade the stock market less than Bitcoin speculators might, and so you see things turn in the crypto market far sooner than you see it, or sooner than you see it in the stock market, which is great. Bitcoin itself is the crypto market itself is a lead-in indicator for financial conditions.
How much
And so
warning did we have here, though? How
over
long?
here, Bitcoin peaked at December 11th, and the stock market peaked
2017?
2017, and then it was 1 month later, January 22nd, that the stock market peaked.
Gotcha.
Now, there's still momentum, right? So even though Bitcoin fell over here and kept falling, the stock market rallied again over here, right? Never, never underestimate the ability for the stock market to rally on bad news. All kinds of dynamics that happen there, but suffice to say, the stock market goes through this the shock over here. Anyways, there's a number of reasons why the shock happened, but you see that it hit both the stock market and the crypto market. And at that time, right after there, the Federal Reserve, as you see on a teal line, stopped raising rates. So they announced it, they're going to stop raising rates. So everyone knows that when it peaks out, that chances are they're going to start cutting rates and put money back into the system. So, so as that expectation comes about, Bitcoin increases, right? Bitcoin increases in anticipation for more money coming into the system, right?
Got it.
Same thing here for the stock market. But it's all really choppy. As you see here, the stock market is all really choppy because the yield curve is inverted, financial conditions are tight, there's not a lot of lending happening. It's tough, so there's a lot of volatility.
So the
And
yield curve inverts, first dip, second dip, then we get a recession. The recession happens, and then the quantitative easing goes up,
exactly. So over here, we notice that
and
um,
the federal rate goes down.
well, that's right. So here's the interesting part: the rate cuts started happening before COVID hit. This whole red part over here, this is all COVID.
Hmm.
All right. So before you think that COVID caused any of this, just take a look what happens over here. The Federal Reserve starts cutting interest rates as of July 19th. So it's summer 2019. Bitcoin is sort of like sideways here, right? Just like we saw sideways over here. And we know that Bitcoin, when it hits, it's going sideways. It hits a floor. It's preparing to launch up. The stock market, the yield curve had already inverted before. Now it went deeply negative, and so here is the peak in the stock market. COVID hits, the world shuts down. Boom, everything plummets down. Now I should have known, Peter, had I known what I know now then, that money was being flowed into the system. Right, money was being flowed in the system here and here. Right.
Hmm.
And after a yield curve inverts, the yield curve starts to go up after that. So there should have been expectation that a flood of money was coming into, was already headed into the system. Plus, we know that the last thing that the Federal Reserve wants is for the stock market to go down and stay down, right? Since
Why is
2008.
that the last thing they want?
Well, we saw that since 2008, they've been juicing the system in order to keep the longest expansion on record, right? They don't want the stock market to go down. The stock market has so much to do with our system. Our system is a house of cards built on debt, and like we said before, if that debt gets destroyed, then the money that's created from that, the loans, gets destroyed as well. Because in our system, credit is actually money. Peter, the cash in your account, the bank doesn't care about that. The bank doesn't want any cash. Nobody wants cash. And people who have money don't want cash. They want assets, baby. They want real estate that goes up in value. They want stocks that pay dividend and that go up in value. They want to make money. Your cash is sitting there, is being eaten away by inflation. Horrible, right? And so the last thing that the government wants or the Federal Reserve wants is for stocks to come down and stay down. They'll do anything to prevent that. So any time to buy here was actually a good time to buy. There's all good buying opportunities. And people like me who are calling for the stock market to come down all over here, like just to keep falling, was sort of silly. Because even if it did, it was going to skyrocket back anyway. Right?
Because the Federal Reserve is not going to allow it. The major player in the stock market refuses to let that stock go down. So if you are betting against that to let the stock market go down, if you're betting against that, you're betting against gravity.
Well, the Federal Reserve wants lending to happen because lending is how money gets issued. It is not issued because the Federal Reserve prints money. If it was, they wouldn't need to manipulate the manipulate the banks. They would just issue money. Banks create money through lending. That's how money is created. And so, what was going on over here? Oh man, all kinds of things are happening here. There's going to be whole classes in universities taught on what happened after the COVID response. But basically, lending just ground to a halt. Just ground to a halt because who has money? Who's going to lend it out in that environment? And so the Federal Reserve is like, just ratchet up, guys. Open the floodgates. The floodgates. Legolas, don't let him pass. Insane, right? Money flowed in as never before, and what did we see? We saw the blue line, the yield curve, increase dramatically. We see the stock market increase dramatically, and we see Bitcoin increase dramatically. Now, it's a little misleading here. I should tell you that the Bitcoin line that I'm showing is actually the logarithmic line, right? If I were to actually show you Bitcoin, the chart regularly, it would look like this: this orange flat, and then spike, spike, and then this is what happened in 2020. Can
Could
you see
you
it?
just quickly explain a logarithmic? Why is that different?
Sure. So
Only because you say a logarithmic chart is the best way to look at a chart.
the normal chart that we're looking at has the y-axis goes up incrementally. It goes from 0, 1, 2, 3, 4, 5, 6, and so on. So every move is related to every other increment to one for one.
Mhm.
But you use a logarithmic chart when you want to show exponential growth. Because if you were to show exponential growth on a regular chart, let me just pull this up real quick. Actually, I'll show it to you here. So
Whoa, whoa. Tell me you don't look at that all day, Tom.
all day a day.
We gotta put an epilepsy warning on this video.
So this is Bitcoin. Let's take a look. Bitcoin here. So this is the Bitcoin chart. If it's just regularly, right? So Bitcoin went from whatever it is, a couple of $100 to 20,000 here in 2018. So this is the first big bubble that we all heard for. Oh, I can't show my. Sorry, 1 second here. Actually, I'm not going to show that. So this first big hump is when we all heard about Bitcoin. Like the whole world heard about Bitcoin. You know, that's where a crap ton of Bitcoin millionaires were created over here. And then the epic crash from 20,000 down to 4,000 pretty much took the wind out of the sails for people. They're like, all right, a lot of people bought around the top over here, and they lost quite a bit of money. But then we had a run up. Then we had another run up that happened in 2019. That's anyways, that had to do with the halving. And then what happened is that what we see here, this big explosion up, that shows you how much money was sloshing around in the system. It just exploded Bitcoin from around 12,000 to 60,000.
Pretty good sign that when people
Now,
had money, they wanted to buy Bitcoin.
well, people who have money, who have excess money, you want to put that money to work, and you want to put money into work and the thing that might yield you the highest return. And so, if you have an appetite for risk, you go to the riskiest asset that could give you the highest thing. So that's what we see here. But if this chart doesn't actually show the price movements are all skewed, right? So we see here the in from 2021 to 2022, the chart is huge, and then but when you look over here at from 2015 to 2017, you can't really tell anything what's going on the chart there, right? But if you
Yeah.
change the chart to logarithmic, where what you're doing is uh, it's a type of way of demonstrating the changes that are happening between the prices. Then you're seeing here more proportionally what it was like at the time, what it felt like at the time, right? The guy who's buying Bitcoin over here at 25,000 feels the same as the guy, or sorry, let's say here at 5,000 feels the same as the guy who bought Bitcoin here at 250. It's like proportional to what it was like for them to run up and to see the run up. So
All right.
logarithmic just makes it that the chart, instead of going 1, 2, 3, 4, 5, it goes up 10, 10, 100, 1,000, 10,000, and so on. It goes up by by orders of magnitude. I'm sure that
Understood.
really mean much. I want to stay away from the math, but
No, it means a lot because I hear Raul Powell talking about log charts. I've heard you talk about it. I did think it's an important thing to talk about, and I do understand it now better than I have before. A log chart shows exponential ranges better than a linear chart.
exactly. So if you have an exponential asymptote on a regular chart, on a linear chart, it would look like a straight line, a linear line on a logarithmic chart. So whenever you see a straight line on a logarithmic chart, then you know you're looking at an exponential rate.
Gotcha.
So, which is why I'm showing it here, because it's easier to see what was going on at the time as opposed to the nominal, just the number of what the Bitcoin was at. Look,
All
we're
right.
talking about shapes here. We're talking about relationships. That's what's important here. Don't worry so much about the number.
Looks like we're getting to the good stuff.
We're getting to the good stuff. All right. So over here, we know we're headed towards, at some point, we're going to head towards this yield curve inversion for this blue line. We also know that the Federal Reserve is going to be hiking interest rates.
That's what they said.
That's what they're saying. They're going to be hiking interest rates. The world, the United States, the U.S. is clamoring for it because they say inflation is through the roof and we need to raise interest rates. They don't realize that what they're asking for is for them to destroy demand, Peter. That's what people are asking for. You're going to raise inflation. You're going to raise interest rates to fight inflation. And people don't get it, that what they're saying is that we want some of us to lose our jobs. We want
Hmm.
some of us not to be able to get loans. We want it to be harder for us to start businesses. We want it to be harder for us to live in order to bring inflation down. Like people just don't get that that's what they're asking. And the Federal Reserve is like, okay, then that's what we got to do. And so we see here that the yield curve is falling, so financial conditions are getting tighter. The Federal Reserve rates are going to go up, means financial conditions are going to get tighter, and they've already announced that they've stopped quantitative easing. That means this yellow line is about to plateau, like we saw over here, right?
Mhm.
Well, that's like a car going 60 miles an hour, and then all of a sudden the person puts it straight into reverse. And what did we see? We saw Bitcoin fall dramatically. Now, it doesn't look dramatically over here, right? But if we go back to that chart we were looking at before in a linear way, we saw Bitcoin fall here, right? Bitcoin fell here um, about 40 to 50%. Let's call it 40%, right?
I
Right.
don't like looking at this chart, Tom. I don't like it.
So that means this is indication that the economy is being that the money flowing in the system has been pulled away. And so it's no wonder that we're seeing a drop in the stock market. What's interesting here is that Bitcoin saw this beforehand, right? Bitcoin peaked here at in November 2021, but the momentum still carried the stock market, and we have here that it peaked in January, and since then it's been going down. So the question now here, Peter, is if financial conditions are tight, as tight as they can be, with interest rates going up, the yield curve falling, and quantitative easing slowing or rolling over, are assets likely to go up or down?
Say that again.
If quantitative easing is slowing, yield curve is falling, going towards inversion, and the federal funds rate is going up in order to tighten financial conditions, that what do you think happens to asset prices? Do they keep going up?
You tell me.
They crash, Peter.
That's what I expect.
They crash. All right. So the question we have right now
You
is,
think asset prices are going to crash? Now, what I was thinking is that there's going to be less money going around, that things are going to get tighter. But why does that make asset prices go down?
because our economy doesn't work on how much money there is in the system. It works on what is the increase or decrease of that money. What is the acceleration or deceleration of it?
That's velocity.
That's the velocity exactly. We don't care how fast the car is going. We care, is it ramping up to that speed or ramping down to that speed? So
And
if I
when
were just
velocity goes down, asset prices go down. Why?
because um, the money created in the system requires old debt to be used as assets to be used as collateral to borrow more money on, and people who have debt who pay off that debt, who pay off the interest on that debt with new debt, right, with a lower interest rate, they keep paying off the old one, then um, they can't do that. And so not only is new money not being created because they're not taking out new loans, their old loans might get defaulted on, which means that money then disappears, and all the things that was built on that money gets disappeared. We saw this happen in the 2008 crash.
I was just about to say,
Crash.
yeah.
You have a house, and the house has a there's a mortgage on that house, and so that mortgage uh, is on the balance sheet of the bank, right? They it's an asset and a liability. They're gonna forgive me. I don't know enough about bank balance sheets in order to talk about how they see it, but suffice to say, it's a loan that needs to be paid back. And
Mhm.
so what the government can do, sorry, what the bank can do is that that loan can actually be used as an asset. They could sell that loan to somebody else because that loan has this money that's being paid by the homeowner. There's this guaranteed cash flow, right? And like we said before, people don't want just cash. People with money don't just want cash because their cash is losing money every year because of inflation. They wanted to put it in something, so they're always looking for something to buy, right?
Mhm.
So better for them to buy a loan from somebody that's this cash flow coming in, than has this interest rate automatically built into it, than to just have cash alone. Now, once that person, the second bank or the second financial institution buys that asset, now they can also lend it out, or they could borrow against it, or they could sell it to somebody else. And as they use it, as they leverage it in order to get now that liability now is an asset on the person's balance sheet, they can use that as collateral to get another loan, right? And that loan that they get is a liability on on that financial institution's balance sheet, and then they could sell it to somebody else, and that becomes an asset, and then this
But
whole thing.
why
And
does
it's
the
all
asset l- decrease in value?
exactly.
But
So the
why?
asset, no, the asset, the house doesn't decrease in value, right? The house, the mortgage, the loan is a debt to the homeowner who pays their mortgage every month.
Hmm. But you're
And so
explaining why asset prices go down. Why we're expecting asset prices to go down.
so what happens if the so that money that money's being created from all these loans are going somewhere, right? It's going to buy more real estate to and causes real estate to go up in
Because
prices. It goes
demand
to
goes
buy
down.
stocks. No, I'm just saying in the regular system where
Yeah.
the we talked about the house, and that house has a mortgage, and that mortgage is now an item on someone's balance sheet, right?
Hmm.
And so now they can use, depending on how they deal with it, they can use that cash flow item, that loan on their balance sheet, as collateral
Hmm.
for them to be able to borrow money.
Gotcha.
And so they're borrowing money on top of a loan. They're using a loan. They're using debt as an asset
Hmm.
to buy money, to get more money. And so they get a loan, and then that money they might use to buy more real estate, to rent out. They might use it to buy stocks in the stock market, right? So it's just house of cards built on top of debt. Now, if the homeowner defaults on that loan, because financial conditions get tight enough that they get fired, right? They
Hmm.
can't afford that, or they can't afford that home anymore. Well, all the debt that was built on top of that disappears too, because all that other loans were collateral that had this value before because the person was paying the mortgage. But if they're not, then that thing doesn't have any value anymore.
Hmm.
It's a defaulted loan. They're not even going to get the principal back, much less the interest rate. So it goes nowhere. And so uh, debt gets hypothecated, gets leverage again and again and again. Peter, we're not talking 2, 5, 10 times. It could be dozens of stacks of debt on top of that. And so the last thing the government or the Federal Reserve wants is for the value of the assets to come down, right? Because the whole Ponzi scheme is set on it, right? Pension
But
funds.
if they increase the federal uh, rate and reduce quantitative easing, they might not want assets to go down, but aren't they causing assets to go down?
Yes, exactly. It's sort of like caught between a rock and a hard place, because
But
what
they're doing
happens
it
is that
because people are demanding it because they're feeling inflation.
exactly, and the people think that the inflation that they're feeling comes because there's too much money sloshing around in the system, and there is a lot of money sloshing around the system, but that money's been sloshing around the system for a decade now and more. We saw the chart, 40 years, interest rates have never gone higher than the previous peak, right? But people have this, they're very linear, they're very short term, so they think that inflation, oh my God, it just started now, all this money printing, we gotta put a stop to it. And so politicians are not gonna get elected if they don't talk about it, and the Federal Reserve chairman will get replaced if there's a problem, and we're gonna fight inflation because people just generally don't understand how these things work. And
So this is
so
what you explained to me previously that before the Federal Reserve was doing this whole playing in the market, but now a large part of what they do is this expectation game.
yes, let's not get into that because that's a whole philosophical debate as to what inflation is. But suffice to say, as prices of things go up, it's hurting people. One of the classic phrases is that the cure for high prices is high prices. Eventually, get to the point where it's too painful for people. Gas
Mhm.
is high, and food is through the roof, and the rent and medical bills, it just gets too hard, and they demand that the government does something in order to bring the prices down. And the only thing the Federal Reserve can do is destroy demand. Now, people don't realize that the demand is already being destroyed by the high prices because they don't understand the flow of money. So they don't understand that they're asking for interest rate increases on top of what's actually already a tightening system.
So why doesn't
We're
the Federal
actually
Reserve just don't do anything and eventually demand will fall?
because the Federal Reserve needs people to think that what they do actually influences the economy. but it doesn't really. The Federal Reserve doesn't print money. The banks make money through loans. And the banks are not going to want to, if they don't want to lend out money, then they don't want to lend out any money.
Hmm. I
No
get it.
amount of cutting the interest rate is going to, or modifying of the interest rate is going to change how they think. If they think Jimmy is not going to have a propensity to pay this back, they're not going to do it. But they need people to think that the Federal Reserve prints money, because then you go, well, what's the Federal Reserve do? If they don't print money, what is it that they do? So they go, well, we control the interest rate. But the Federal Reserve doesn't really control the interest rate. It's the bond market. We saw that chart at the beginning with the red, yellow, blue, and purple line, right? Well, what happens is that actually, let's take a quick gander at that. So what happens is that right now, let me overlay the rate. So the teal line again is the Federal Reserve line, and the red line is short-term interest rates, 2-year interest rates. Well, do you notice over here it's always the red line goes up before the teal line does, right? And the red line comes down before the teal line does. Red line goes everywhere we see it. Red line goes up before the other one does. Red line comes down before the other one does. Here, same thing. The red line bottomed um, here, and it was only a few months later that the Federal Reserve starts raising interest rates. It's the bond market. It's the money that goes into these the bond system that actually tells the Fed what the market expects them to do.
Hmm.
And so they have to, when the bond market prices move, they sort of have to follow it, right? So over here, if you take a look at what's going on in 2022, the normally by the time the red line got to over here, the Fed should already be increasing interest rates, but they didn't. So the cycle happened, the business cycle is happening, so that the red line is crazy high, and the Federal Reserve hasn't raised interest rates even once.
Why?
Because the Federal Reserve actually knows that the long-term trend is for this to come down, and that they need to stay around zero interest rates. That the economy can't actually handle high interest rates, because then the yield curve is low, right? The yield curve is low, like we see over here, and falling. Lending doesn't happen, and things get rougher and rougher. And what happens is that Ponzi scheme of debt disappears as the money disappears. So they know that increasing the interest rate will collapse the economy if they
Then
do it
will
too much.
then that yield curve will drop below the red line. Is that what's
Exactly. Well, that'll drop. That's going to drop before it'll always eventually come down. But the question is, what the Federal Reserve was trying to do was wait out this red line. They wanted to wait out this red line for it to come back over.
have they ever done that?
No,
Yeah, I'm not seeing it.
but they had no choice. They were low for the longest time. They tried raising rates. They got their rates back up to 2.5%. The previous cycle had rates at 5%. They couldn't even get back to half. They got back to half of what the interest rates were before, because they were like, "Holy crap!" When they raised interest rates over here, what happened was that the stock market just puked. This happened in the stock market, and they're like, "Whoa, minute! Let's back it up there." So the last thing they want is to, I mean, hell, if they could keep it at zero interest rates forever, I'm sure they would prefer to do that. I mean, that's what Japan did, and so now they waited and waited and waited and waited, and then like commodity prices go to the roof, and then Russia decides to invade Ukraine, and prices go to the roof, and they're like, "Oh my god!" People are screaming inflation, and for a year they're like, "It's transitory inflation. It's transitory inflation. Inflation's not going to last long." And now they're like, "Hey, well, no, inflation's lasted a long time now. We need you to make things harder for people." And so they're like, "Okay, we gotta." We'll see. We'll see what happens tomorrow. We're going to find out if they raise interest rates. All right. So that doesn't matter to us. What matters to us is that we know they're putting the car into reverse at exactly the wrong time. So the question is, how much further have we reached a bottom in equity prices in the stock market and in Bitcoin? So if we take a look at previous times of drawdowns for Bitcoin, um, which is a truer indication for the amount of money flowing around in the system, you'll notice that the first time Bitcoin fell, it fell 86% over a period of 400 days.
Oh, I feel like we're getting into this. Is it? This is what we need to know. All
That's right,
right.
and bottomed. It bottomed here.
Yeah.
Then it over a period of 1,000 days, it rose 11,000%. So if you put $1 in, you would have gotten 116 times your money. Um, so it bottom so drops 86% for over a period of about a year, and then it increases for a period of about 3 years. Then it dropped again 85% over a period of a year, and then it increased for a period of about 850 days, almost 3 years. And now we're in this cycle, this part here, where it dropped it dropped only a little bit. It only dropped about 40%, which means if it were to drop again 85%, we should get around to around 10,000 on Bitcoin. So the question is, with monetary conditions tightening so much, right? Is it likely that we've actually seen the bottom in crypto? No. Just like over here, when you see here how there's this huge drop off, like right at this point,
Mhm.
right here.
Yeah.
So if you thought that this was the bottom, no, there was still more bottom coming in. If you thought over here that the midpoint here was the bottom, right? You were wrong. There was still more bottom coming in, right?
Hmm.
That would suggest that there's far more bottom coming for this right now. In fact,
Oof.
that and the stock market. Now, here's the good news.
All right.
That quick bottom, the big bottom over here and over here, does not last long, right? The drop seems pretty painful, but it doesn't actually last long. Over here, it lasted for a period of a week. This bottom over here, this bottom before it came back up was it dropped December 11th. It was down, and then by April of the following year, it was back up. It was just a couple of months of 6 months, a little bit more than 6 months, and it was back up. And so the best time to ever have bought Bitcoin was all on those massive drops of 85%. Once you got to around that area, it was never a better time. And you're not one of those people who bought at the top and you have to wait till the next time it got to that price in order to make your money. You're making money direct là, tout de
Immediately.
suite, immediately, right? So, and all these major drops. So the only question is the demand still there for Bitcoin, right? And the demand is still there. We've seen China ban it. We're seeing issues inside of the EU where there's talks about banning it. We're seeing all kinds of problems that would make the crypto market should be lower, but it isn't. The adoption rate has been up and to the right, this entire time, right? And so, if you're betting on that, and you're betting a reasonable amount that you're willing to lose, what you want to be doing is looking out for a massive drop until it gets to around 20,000 to 10,000, and you want to be buying Bitcoin around that spot. In fact, any type of crypto.
So,
And
do I sell my Bitcoin now and then wait for the drop?
the only reason to sell it now is if you need it. You can't wait until the price of Bitcoin gets back up to the level. The thing
No,
is,
but if you sell it now, you'll get a
yes,
pool of money, and then you'll be able to
absolutely.
buy more Bitcoin when it gets down to 10,000.
Absolutely. So that is a strategy.
That's
Totally.
trading. Mhm.
But for me, I would say the person who bought it lower, like if you bought it lower and you're in a profit, sure, sell all of it, sell some of it, and wait for a drop and get back in. Now it could be wrong, right? It could always explode from here. Like I'm not trying to say that that can happen, but what happens is that You got to look at the risk reward, right? It's about money that you don't want to lose. So if you sell it now, even if you're wrong and the price goes up and it gets to new all-time highs, well, the next time we see the previous high, it's like when we saw it over here. So over here in 2014, we see that high again over here, right? But that wasn't a bad time to buy,
Hmm.
right? Because then you had still a huge part of the move coming up. If you bought it over here in 2018, and you have to hold all the way till it got back up to where it was in 2 years later. That's not so bad. Remember, this move over here that we're seeing that looks like such a tiny move, isn't a tiny move. This move is bonkers, right? Let me just remove the indicators. Right, this is a pretty right. This is a pretty substantial move. So if you bought it over here in 2000 at the beginning of the chart over here in 2017, 18, and you had to wait till 2020 in order to get it, I mean, you still got a nice write up. In fact,
Hmm.
you're still in profit even after all this drop, right? And so you just have to decide what it is you need. If you need that money to live, well, then you have no choice. I would say, I would recommend that you sell it, right? If I was a
Financial advice.
financial advisor, that's what I would do. I would sell it because who wants to write that down. So let me just put this back up. But if you're looking to buy, if you weren't in the crypto space, you feel you missed out. I would say now is not necessarily the best time to jump in. But the best time to jump in would be at the next fall. Any time during the next fall, any ride down from the previous low, let's say from 30,000 all the way down to 10,000, you could be buying a little bit, a little bit, a little bit, a little bit, because within fairly short period, it could be. Well, here's the thing, Peter. This is the last thing I'm going to end on. This is a 2-hour stream. I can't believe we've been going. You guys have been very patient, and I appreciate it. Um,
It's been great.
what happens is that we know that the government and the Federal Reserve doesn't want stocks to stay low, right? They're going to want it to go back up because it's going to be super painful. So they're going to jack up rates. If it's anything like it was last time, they won't be able to get up to more than half the previous height. So they'll get to 1.5. I have my numbers say something between 1.5% interest rate to 2.7 on the 10-year interest rate. So it'll get back up to a certain period. The yield curve will invert. We'll have a recession that happens. And when the yield curve inverts over here, once the yield curve inverts, we know that likely the yield curve will then bounce up again from there, and that the Federal Reserve, whatever interest rates they raised it to, they're going to lower it, right?
Mhm.
And just for good measures, they're going to kick this up a notch, right?
Quantitative easing,
Exactly. Quantitative easing.
the yellow
So
line.
then you're going to have, just like we have the perfect storm of bad stuff happening now to bring the stuff down, we're going to have the perfect storm for, my God. I mean, unless we're talking about the global financial collapse of the economic system, in which case, bullish Bitcoin, right? But chances are they're going to just dump massive amount of money, and we could see a skyrocket, uh, just to the moon price.
All right. So, what about this? Crash proof? What about this makes us crash proof?
Crash proof because you can sell now and avoid the next 40-50% drawdown. And your life doesn't have to be ruined because the best time to buy stuff is when there's blood on the water.
And
That's
you
the
don't
time to
have to
buy,
like
Peter.
emotional panic when it drops down to 20, 10. You're not going to be losing your mind selling at extreme lows or whatever. You'll just be like, look, I knew this was coming. The market signals indicate. We see Bitcoin taking a dip. That's a early warning. We see or hear about warnings of a rate increase. We see, what was the other indicator?
Quantitative easing and slowing down.
Quantitative easing is slowing down. That's right. All right. All right. And
So
the
you're going to
yield
be looking
curve
out
is
for stuff.
coming down.
You're going to be listening out for yield curve inversion, right? You can
That's
either
the
have
biggest
this chart.
signal here, right?
Yes, because we already know the rates are going to go up, and we don't even know that quantitative isn't as slow. So we're going to wait for yield curve inversion, and we're going to wait for around 20,000. If you see 20,000 on the Bitcoin price, it means we have a lower low, and that which means that it's lower than the previous low that we just recently had, and then that's the time to start buying. We don't know how long they'll stay there. We know it could be a week, it could be a couple of months, but you're gonna have time. You don't have to like run to your computer right away and do it. But once that happens and we get to a certain plateau point, we know it shouldn't go down much further than that, and that the rise from there should be pretty significant. So you're looking for a yield curve inversion. You're looking for the Federal Reserve deciding we're going to cut rates, and you're going to look for quantitative easing to start. You hear any of those things start to go, now it's time to make your money, bro. Now, here's the thing: now's a good period to save, get some cash on the side, set up your wallets properly, get ready to go and buy. You could set orders on different exchanges that I want to buy it when it gets to this price. You could set that all up so it happens on its own. There's ways to prepare yourself for this. When winter's coming, that's the time to prepare for. That's the time to gather your resources, collect yourself, so that you're ready for the spring. That we know the spring will come, and if it doesn't, then we have bigger problems. But if it does, you can make a lot of money. One thing I am also recommending, or not recommending, you can make money on the downside. You can make money with the crash.
Shorting
And
it?
so, yes. So you can use options to, we're not going to go into all the details about options, but
Let's go
there's
into all
ways
the
to,
details about options in the
well, if
different
people are
ways.
interested, if anyone asks about it, I'm glad to go through the position I'm talking about. But you can make money by shorting Bitcoin, which is betting that Bitcoin will fall dramatically. And so there are bets that can yield you, 5, 10, 50 times your money on relatively small amount of money down. But that's complicated. But it's a way you can make money on the downside. But don't do that. The real money is made on the way back up. Real money is made by when everyone's panicked. You buy the stuff because your indicators are showing this is a good time to do it, and you ride it all the way up, and then you're just laughing from there.
Keep calm, watch the markets, wait for that yield inversion, and then get ready, baby, because we're going to the moon. Well, this is way more optimistic than I thought when we started this, Mr. Crash Proof. Apocalypse is coming. Very
I like that you
optimistic
find that
in the future.
increased unemployment and
I
people losing
do.
their jobs and
I do. I
credit
do.
creation discretion.
Look, as I
Very
understand
optimistic.
it, with the business cycles, it was bound to happen. All right. People are people, the markets are markets. But here we are, poised for a dramatic drop, which is going to, anybody who hasn't watched this, anybody who doesn't know what's going on, they're going to freak out and I'm done with Bitcoin. I'm never going to do it. Sell it at 80% loss. I'm out. And they're just going to watch it go up, and they'll be like, it'll come back down. Watch it go up. They're going to come back down. This all is a garbage Ponzi scheme. And the rest of the people are cool heads will prevail, make money, buy Lambos. This is great. This is great. First, you get the charts, then you get the signals, then you get the
Make
power.
money.
There you get that money. All right, this has been a lot of fun. It's funny. We tried this yesterday. We did an hour into it. We got it through half of what we got through here today, and it was tedious. No, it wasn't tedious, but this was a lot
open
of
mic.
fun.
It was my open mic session.
It was open mic. You got to work it out.
I didn't have my
work
suspenders. That was a problem.
This has been a lot of fun. You guys stay tuned because we're actually working on a crypto comedy show. So if you're looking for entertainment, if you're looking to learn about crypto, stay tuned to the channel. Look out for that.
It'll basically be what we just did, but entertaining.
But it'll be funny. You'll cackle and you'll laugh. You'll feel good. At the end of it, you'll leave either buying Bitcoin or being very happy with the coins that you have. This, you said Bitcoin. This affects the whole crypto market. Ethereum, Cardano.
All of it.
All of it.
I don't know that it's Bitcoin I'm going to be buying. It's going to be Cardano. I want to be buying a hand over fist. But
Ooh, Cardano.
you know what I mean? If that thing drops to 37 cents, you get a bunch there, and then within 2 years, it's at $5. Yikes! I won't be talking to you anymore. That's for sure. I'm going to be on YouTube with you people.
I'll be on TikTok. Tom, you've laid it out. It's in stone. It's right here. It's online. Can't go anywhere. If it goes down and back up, you will have predicted it. So we'll see if you're right.
Well, chances are I could be a nice contrary indicator, and it goes like to the moon like now because you know that's how the market likes to uh give you
Whatever.
maximum pain. Maximum pain. Whatever you think, they go, "Oh, great," and they freaking nail you in that way.
You've told me there's actually indicators out there that you do the opposite of.
That's right.
So it's going to be useful.
So
Follow
whatever
Tom
Peter
for
Schiff
any of this.
does, I tend not to do what Peter Schiff.
Peter Schiff is right. Goals at 2,000.
Oh yeah, 2000. He was calling for 5,000 gold just a few years ago. So excuse me. I saw today a video. Why gold's going to go to 100,000? If gold goes to 100,000, Peter, we're going to be out in the streets with guns. You know how
It's the
bad
end of
things
the
have to be
world.
for gold to be. People have to be just burning their money. Like, get these dollars out of my pocket. Gold at 100,000. Get out of
You don't want to
here.
live in that world.
No.
All right, this has been a lot of fun. I think that's all we have left to say. We went through it, right? How to profit, crash proof, how to profit from the upcoming crypto collapse. We looked at market indicators, understanding charts and bond yields and all that stuff. I know more about the market now than I ever have before. And I watch financial news on the regular every single day. I watch hours and hours of it every single week. And now I understand it better than I ever had before. Thank you, Tom, for giving me and giving us this education. It's been a lot of fun. Once again, proving big brain in that. But you see, twins, not the same on every level. I got to tell you that. All right, not the same on every level. Do I have a? Do I feel insecure? No, of course not. Of course not. I have
Oh,
this cool shirt.
I mean, you should. Come on. You have like zero suspenders. I don't even understand where your
I have no
confidence comes from.
suspenders. I do have a bow tie because of your wedding, properly planned because you looked at the charts. Tom, this is a lot of fun. Is there anything left to say?
No, I look forward to coming back with top 10 stock picks. Because you're time to buy
Stocks.
tech soon. Can't wait to buy tech. Gotta get
All
that
right.
Tesla. Gotta get that ARC.
Keep calm. Don't panic. Everything is going to be okay eventually. Invest only that which you're willing to lose, and maybe don't watch CNBC. I don't know. Just going to throw out some good advice there. Watch CNBC for entertainment. Don't watch it for investment Advice. Good to kind of know the sentiment of how people are feeling, though. Bye, 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 bye. All right. My name is Peter Hartman,
I'm Tom Hartman.
and you're watching Jumpstart
Jumpstart
Live.
Live.
Take care, everyone. Oh my goodness, we weren't streaming this whole time.